Welcome to the Asian Connection Mortgage Podcast, where we connect Asian Canadians together to talk about anything related to real estate, mortgages, and finances, based out of Vancouver. Our host is John Lee, mortgage broker with Arise Mortgage. Grab a bubble tea and enjoy the episode.
Welcome to another episode of the Asian Connection Mortgage Podcast. This is John Lee, your mortgage broker in Vancouver. And today we're diving deep into something that affects every homeowner and buyer in Canada. And that is the Bank of Canada's recent rate decision and what it means for your mortgage strategy. So on September 17th, the Bank of Canada made a significant move. You probably heard it in the news. They've cut the prime rate from 4.95%, and now it is 4.7%. But this isn't just another rate cut. It's part of a bigger economic story that you need to understand before making any mortgage decisions. So let's break down what Governor Tiff Macklin said and his team, why they made this call to reduce the rate, and what the bond markets are telling us about future moves. And most importantly, whether you should lock in into a fixed rate or go with a variable. So let's talk more about the Bank of Canada decision. So, like I was saying, on September 17th, they reduced the rate by 0.25%. So now the prime rate at the time of recording is 4.7%. And this is interesting because for a while they've been holding the rate steady, and then now they have reduced it. And it's to continue the effort to support Canada's slowing economy. And these are things that they pointed out. So first off, the economic reality check. Canada's GDP, which is the growth of the country, has been struggling. We're looking at a projected 2.2% growth for 2025, and that is just just modest at best. And the bank cited three key factors in their decision. So first is the inflation. So inflation is cooperating despite the tariffs. So we're seeing core inflation measures like the CPI numbers that they reported. It's around 2%, which is what they want. And this gives the bank breathing room to focus on growth without worrying about runaway prices. And that was a big issue because they're like, oh, there's gonna be tariffs and tariffs are going to increase prices. Well, thankfully, yes, the tariffs are impacting the world economy, but because the economy is doing so poorly that uh, the tariffs aren't affecting inflation or core inflation as much. So second, trade tensions. So our exports sector, particularly in the manufacturing, and we don't really see much of this in BC, but in Ontario and Quebec, there's a lot of companies in the manufacturing industry, and they're facing headwinds from ongoing U.S. trade uncertainties. The bank recognized that high rates were becoming a drag on business investment and consumer spending, so they decided to decrease it. Also, mainly because Ontario and Quebec, they're the two largest provinces in Canada. So the health of those two provinces is very important to Canada. And lastly, the labor market is softening. So while unemployment isn't spiking, we are seeing job creation slow and wage growth moderate. So this tells the bank that the economy has enough slack to handle lower rates without triggering inflation. Now, here's where it gets interesting for your mortgage decision. The bank has two more meetings this year, October 29th and December 10th. And the bond market is already pricing in what might happen. So here's the prediction. So October 29th, the bond futures are showing roughly about 52% chance of another 0.25% cut. So, you know, I would say, it's likely going to be a cut. And this is why, because um, there is a lot of bad news in the economy, but the cut is not for sure yet because there's still a lot of data that needs to come out. So what we'll be watching for are three key indicators. So the first one is September inflation data. So this will be released around mid-October. Quarter three GDP numbers and employment trends through October. So those three things are very important that Bank of Canada will be looking at. Uh, the expectation is that all those data will come in soft, but you never know. So if inflation stays anchored around 2% and growth is still kind of sluggish, like what we're experiencing right now, then we'll likely see another cut. And but if we guess any surprises in strength in the economy or inflation goes up, then there might be a pause. So that's the next one. And then December 10th, the very last one before the government goes on vacation break. This meeting is likely harder to predict because it really depends heavily on what happens in October. However, most major bank economists, so like say like from RBC, Scotiabank, or TD, they are forecasting the prime rate to decrease by 0.25% to 0.5% more by the end of 2025. So what they're saying is they're expecting at least one or two more cuts by the end of 2025. So if this projection is correct, then the prime rate will end up somewhere between 4.2% to 4.45%. And again, today's prime rate is 4.7%. I just want to remind everyone that the Bank of Canada is in a gradual mode. So they're not really rushing to cut rates aggressively like we saw during the pandemic. And they're taking a measured approach, which actually gives us some predictability. Because the worst thing they want to do is cut really quickly, like what they did during the pandemic, and then they have to reverse everything just as fast to fight the inflation. Another thing to consider is we need to consider the our friends in south of the borders. The U.S. Federal Reserve's decision heavily influences our bond market. So if the Fed holds steady while weaker, it could pressure on the Canadian dollar, potentially limiting how far the Bank of Canada can go. Uh, the good news is that the Fed has announced that they are very open to decreasing rates, which also allows us to be a little bit more flexible on our rates as well. So we're gonna get into a little bit more technical stuff. So the bond market. So we also watch the yield curve. So right now, the Canadian government bond yields, which controls the fixed rates, have been declining, and um, the the 5-year government bond has been going down from its peak early this year. So what does this mean? So it means that when the bond yields falls, fixed mortgage rates will typically follow. So right now we're seeing some lenders decreasing their 5-year fixed rates. And what you're looking at right now for 5-year fix will be 4.14% to 4.24% range. And this is great because I remember doing mortgages around last year or a year and a half at around 6%. Now, the variable rate is controlled directly by the Bank of Canada, and we know that when it comes to variable rate, the prime rate is what changes. If you have a variable rate mortgage right now, you likely see that you benefit from the September cut, and you'll immediately see this. If it's adjustable mortgage, meaning if your rate goes down, then your payment will also go down as well. What we're also seeing is that for a while, variable rate has been much higher than fixed rates. But now the spread between the variable and the fixed rates, they're narrowing. So this is good news. It allows borrowers like yourself to truly think about whether or not to consider variable. Whereas before, it's just like I would say 90% of the time, or even more, people would just go fixed because it's so much lower than variable. So, well, I get this question all the time. So should I go fixed or variable? So for those who are considering variable, if you believe that the Bank of Canada will cut to 4.45% or lower by the year end, which is consistent with what the forecast suggests, then variable will make sense. You'll benefit from every cut immediately. And right now, variable rate, we're looking at around like prime minus 0.6 to prime minus 0.7, which puts you at roughly about 3.6 to 3.85% range. Now, you also need to remember that your mortgage is very long term. Like all these forecasts of these great news of rates coming down, it's short term. After rates go down and if the economy does recover, it's very likely that rates may need to come back up again. So that is something you need to consider and factor in. No one really knows when, but very likely, if rates are are lower than it should be, things need to rebalance. And the way to do that is for rates to go up. And for those who are fixed, well, fixed has come down significantly, and you can get, like I said, get a 5-year fixed mortgage around 4.14, 4.24% with big banks, depending on your profile and your down payment, of course. And this makes sense, actually. And this is also something that I'm encouraging people who are a little bit concerned about fluctuation, like they want stability. This is actually a pretty good time to lock in your rate. I feel that we are near or at the bottom when it comes to rate. And if, like I say, if economy strengthens unexpectedly, rates will go up. And generally, I know we had our low rates like 0.99%, and just for the longest time, it's been like fluctuating between 2 to 3%. But really, on average, if your rate is less than 5%, it's actually below average already. So right now, if we're already in the low fours, this is actually a decent rate to lock in for 5 years. So given the current environment, I am leaning more towards variable for clients who can handle payment fluctuations and have stable employment. The probability of further cuts outweighs the risk of rate increases in the near future. But however, if you're stretching financially or prefer certainty, the gap between fixed and variable has narrowed enough that fixed isn't a bad choice. So I hope this was helpful. Thanks again for listening to this episode. Remember to like and subscribe. If there's a topic that you'd like me to talk about, submit your question in the comment section. I will definitely look at it and consider and create content out of it. Have an awesome day, and I'll see you in the next episode.
Thank you for tuning in. If you enjoyed today's episode, please consider giving us a review and subscribing to our podcast on your favorite platform. Thank you for listening, and we'll see you next time on the